Hi, so I want to talk about one of my favorite topics again, just coming from a slightly different angle, and it's the idea that just permeates around the retail trading world. I'm going to, come at this topic from a number of different angles because it is the most ingrained idea in retail trading world, and that is that the market is ahead. So all the people that are selling you technical analysis, all the people that are telling you to use indicators, they all believe that the market is ahead. That's why they're telling you to use indicators. So what I want to do today, coming from a different angle, using a different example to show you why this idea that the market is ahead is not true. So this example comes from middle of 2021, and I originally did an interview with Callum Newman from Fat Tad Investments. We'll put a link in the description. He put that on his own YouTube channel. So he asked me in to talk about the SKEW Index. So the SKEW Index at that time in June 2021 was an all-time high. So for those that don't know what the SKEW Index is, I'll give a brief explanation. So with in the options markets, you have a range of option strikes at any different expiry. You have what we call at-the-money options, so they're options whose strike price is around where the current market is. And then you have out-of-the-money options. And some of these out-of-the-money options, they can go very deep. So for example, for a stock or an equity, you may have out-of-the-money options could be 5%, 10%, 20% away. So both call options and put options. The SKEW Index looks at very deep out-of-the-money options. So options that are a couple of standard deviations away. And so this is measuring basically whether people are what they're paying for these out-of-the-money options. Are they paying very high prices for them? Whereas, for example, the VIX Index is measuring options that are at the money. In both cases, they're looking at options of roughly 30 days or 1 month maturity. So it's been widely said, if you look at descriptions of the SKEW Index, it's often said to be a market that's looking at black swan events, these deep out-of-the-money options, and it's saying that this SKEW Index is telling you if there's a possibility of a black swan event. Now, this is the first thing I'm going to, dismiss right now. In a situation where, let's say we have a situation where investors are buying, let's say, deep out-of-the-money put options, lots of them, paying very high prices for them, sending the SKEW Index very high. If that were happening and they were preparing themselves for some sort of major market move, by definition, that cannot be a black swan event. A black swan event is something that people didn't know was going to happen. And I would argue that if people were prepared, if investors had been buying options, the chances of such a black swan event are reduced anyway because people are prepared. So I find that whole notion to be just bizarre, frankly, and I obviously think it's another one of the sort of nonsense ideas. So if we go to June 2021, let's look at the situation. The SKEW Index was at its all-time high, meaning that people were paying very high prices potentially relative to the at-the-money options. So the out-of-the-money options were trading at a very high price, basically relative to what the broader market was trading. Now, there were a number of headlines around at that time and people on social media saying that this was flashing red and that there was the warnings of a black swan event out there. The chances of a black swan event were high and we should all get ready for one. What's really interesting is that at the same time, the VIX Index that was measuring the at-the-money options had actually been trending lower. The VIX Index had been moving lower, over a number of months, just, generally grinding lower to what was actually trending at one of the lowest levels that had been in months. So these two markets are telling us two different things. If there really was fear of a black swan event, we would expect all option prices to rise, not just the at-the-monies. You would expect not just the out-of-the-monies, You would expect at-the-money to rise as well if there was genuine fear of a black swan or genuine fear of a major market move. There's no way option market makers would be selling options that cheap of the at-the-monies as well. So here comes a couple of interesting points. Firstly, the idea that the market is ahead. People use indicators and they use technical analysis because they believe the market is ahead. But here we have two different indices looking at the same type of options, 1 month options on the S&P 500, but just different styles of them. One's looking at out of the money options, deep out of the money, one looking at the money, and they're telling us two completely different things. If you were looking at the VIX Index, and if you believe the VIX Index is an indicator, and there are many people on social media that will tell you the VIX is an indicator, again, I would say categorically it's not. But if you just looked at the VIX Index, you would say, nothing to see here. VIX Index is going down. It's trading at its recent lows. In fact, it's several month lows. If you were looking at the SKEW Index, you would have a completely different view. If you looked at it as an indicator, you would say, wow, SKEW Index at all-time highs, and as many headlines said, flashing red, this is telling us there's something big about to happen. That's the first interesting point, I think, to make. Two different indices on the same market, options markets, we're just looking at two different types of options, telling us two completely different things. Which market's ahead? If the market is ahead, and if you believe in indicators, and if you believe in technical analysis, you must believe the market is ahead. My challenge to you right now is, which of these markets is ahead? They can't both be right. They're telling us two different things. So what's really happening? How should we really understand what was going on? Well, you have to understand it from the perspective of how the markets really work. Markets really work not by being ahead, it's they price in outcomes. In June 2021, equities had been rallying. Volatility had been falling. It had been falling for several months. Now, we were also about to go into earnings season. Investors were not scared about a black swan event. Investors were probably quite relaxed. They were sitting there on profits. They were quite relaxed about things. If they were scared, they'd probably be selling equities, but they weren't. They'd continued to be buying. Equity markets were going higher. But with earnings season ahead, it's noticeable and understandable that some of these investors are going to be buying some protection, some hedging for their portfolios. There's also going to be some speculation ahead of earnings season. Some people will be buying out of the money calls, speculating of potentially good earnings results. There's going to be both going on at that time. Market makers, meanwhile, are going to therefore sell these out-of-the-money options at higher prices. They're obviously also aware that in earnings season, the chances of these sorts of moves are a bit higher, so they're going to mark up the prices of these anyway. And when you have low at-the-money volatility and the market makers pricing up and some demand for these out-of-the-money options pricing, which is pushing the prices of the out-of-the-money options higher, you're going to get a bigger discrepancy between at-the-monies and out-of-the-money options, and therefore you're going to see the SKEW Index look high, because really what you're saying is it's relative in a way to where the broader market volatility is. But understandable that both people are going to protect themselves and speculate on some positive outcomes, and for market makers to price those things higher. So all that is going ahead as you go into that earnings season. And what played out was there was no crash. Okay, there was no crash. There were a few moments of slightly higher volatility as earnings were coming out. That's all quite normal. But we're talking about VIX moving from sort of 17 to 19, 20, not really particularly big moves. There was no crash. And over the next few months, the SKEW Index came down dramatically. And equity markets, remained in a reasonable environment. So, here we can see it from a number of different situations. This idea that markets are ahead, and using, whether it's the VIX or the SKEW Index, or realistically anything, there's an indicator, is the wrong way to go about it. All of those things are based on the fact, based on the belief that the market is ahead. The markets are not ahead. What information can we see, therefore? Well, what we can see is what I explained just before. Equities are going higher. People are trying to protect themselves. I would argue that if investors have protected themselves, there's less likelihood of a big crash than if they hadn't. So that's the sort of information we can see going into earnings season. Your job, if you're a position trader, is to work out what is being priced in. How could that affect? What happens if earnings are good? What happens if earnings are bad? If you believe the market is ahead, what you're saying is the market knows what this earnings season is going to be. I just don't agree with that, and I don't think any decent trader with experience would say that. What there is this, what Soros would call reflexivity, this reflexive nature of the markets. If people are positioned one way and there is good earnings, there could be one outcome. If they're positioned another way and there is good earnings, there would be a different outcome. That's how we need to judge this information. That's how we should use all this information. It's still valuable. It still helps us if you're a position trader to make judgments about what could happen, but it doesn't tell us what will happen. There's still the possibility of each of these outcomes, and what we're really weighing is probabilities. But to use them as indicators is just not true. So all of the flashing red lights and the predictions of doom and gloom based on indicators in June 2021 was completely wrong. So again, just coming from a different angle, hopefully that's explained to you why the idea of indicators, the idea that the market is ahead, is just sending you down rabbit holes. It's sending you down into ways of trading that are just not sustainable and is the wrong way to think about markets.